Good morning, Mark. Thank you very much for joining us.
Thank you.
Perhaps if we could just start with a quick introduction, let us know a bit more about where you fit into SocGen.
Yeah, of course. So I'm responsible for what we call Quantitative Electronic Services, QES, at SocGen. I'm responsible for all aspects of the product development, liquidity strategy and service delivery out of Paris and London to the European client base.
Now, of course, you're going to be at TradeTech Europe coming up in just a couple of weeks' time from now. In your panel, you're going to be discussing the benefits of physically restructuring your trading desk.
Yes.
Which in itself is already quite an interesting topic, rather than, I suppose, the more administrative aspect of restructuring.
Of course.
And in this world of near instant digital communications and remote working, do you agree there are any real benefits then to restructuring? And if so, what are those benefits?
Yeah, I mean, the temptation is to see these benefits in terms of efficiency gains and headcount by bringing multiple skill groups together to service multiple asset classes. I think the driver for us has been very different at SocGen, and we've implemented this over the last year and a half. The idea for us wasn't so much about efficiency gains, but more about reflecting the way that our client desks are being structured. So what we've seen, and it's partly a result of regulation as well as just a general trend in the market, is our buy-side clients become much more cross-asset on their own desks. So we're facing off to traders who may have started being an equity trader, who are now actively trading derivatives, whether it's on an equity underlying or fixed income or even commodity underlying. As a result of that, these guys are very used to trading with electronic tools. And what we found was a reluctance from them to face off to multiple desks when effectively for them they're using the same service. So what we've tried to do over the last year and a half is build out a team who can face off to the individual buy-side trader for all their needs, no matter what asset class it is, and really just focus in on the fact this is an electronic algorithmic service and that we need to provide a single point of contact for that trader as well.
So it's really starting to break down the barriers, even more so in this sort of cross-asset world that we live in.
Yes, I mean, it's very much one of the challenges you have is most banks have built these businesses in a silo. And then what we're trying to do is build a desk that kind of sits across all those silos and faces off to the clients. I think if we were trying to achieve that type of result purely through efficiency gains, that would be quite hard to achieve. But what we found is that because the pressure is coming from clients and demand is coming from clients for us to be structured in a similar way as they are, we've got much more buy-in from across the firm to deliver this, and it's been relatively successful.
So would you say this is, to some degree, the death of the specialist trader then?
Yeah, I think the death of the specialist trader kind of gives you the idea that the new type of trader that we'll have on our desk will be a jack of all trades, and that almost feels like a downgrading of the skill set. I actually think it's an upgrading of the skill set. I think to be able to handle even multiple instruments that may be equity-like when they trade, the drivers in terms of a liquidity profile, where these instruments trade, how they trade, the patterns throughout the day can still be very different. So I think what we're seeing is a creation of a new role, which is a specialist cross-asset electronic trader. And that's the same role that we're seeing being created on the buy side, so we need to be able to reflect that.
Now, obviously, a lot of the regulations that are coming in seem to be ostensibly driven towards a specific asset class, but actually, particularly now, are having huge impacts across multiple asset classes, whether they intend to or not. Particularly, I think a lot of people have highlighted EMIR, that it's having significant cross-asset impact, despite being theoretically aimed purely at swaps and derivatives. How have you seen this impacting on your business, and what changes are you making to well, I suppose, ease the flow?
Yeah, I think as you say, it's a fairly naive reading of this type of legislation to look at one asset class and say that's where the impact is. What we're seeing with a whole host of regulation, which includes EMIR, the proposals for MiFID II, FinReg in the US, is a drive towards more transparency in the markets as a reaction from the regulators to the problems that we've seen in the financial crisis. I think what we're seeing, even though MiFID II makes it very clear that in the equity market they've not completed the changes that they want to see made, is a drive towards an equity-type model in the other asset classes. And we think this is where the impact on other asset classes is going to come from. So, for example, we're seeing in fixed income instruments with EMIR and derivatives that we can see a scenario where we move towards a sort of central limit order book, or at least a quote-driven order book, whether that's a single order book or a kind of equity-like structure with multiple different liquidity centres. As a result of this, we're going to see new people come into those markets who are looking for arbitrage opportunities between those asset classes and the equity. So, for example, doing debt arbitrage between the fixed income, the corporate bond, and the underlying equity on the stock as well. That's going to very much change both the liquidity profile of those instruments that are impacted by the legislation, but equally that's going to have a real and significant impact on the equity liquidity profile as well. What drives the equity price? What other influences are coming in real time that actually increase or decrease liquidity and impact prices as well? So when we look at the legislation that's going on outside of equities, the question we're asking ourselves is, how long will it be before the type of behaviour we see on that market starts driving the behaviour on our market? And as a result of that, we have to change how we trade, the signals we use in our algorithms, and also the type of information we're giving to clients, which comes back to the point of you need people on the desk who understand these other asset classes as well as the one they're trading.
And this is another point, actually. You were talking about transparency. And a lot of people are starting to say that perhaps that governments are asking for too much transparency in these regulations, that actually it can negatively impact markets and make it harder to do the right kind of trading that's actually positive for everyone, that you're forced to send out signals that perhaps would actually impact markets just as much as not sending them out, if not more so.
Yeah, I mean, I think in terms of transparency, we're pretty supportive there needs to be more transparency in the market. It's very clear from our feedback from clients around how we trade dart pools, how we run our own dart pool, for example, that clients want to know the detail of what we're doing. And that's only right because it's the client's order flow, so we're obligated to give them that level of transparency. And I do think to some extent the sell side needs to take a bit of responsibility for not having given that transparency in the past. And as a result, there's been more sort of feedback going to regulators that people are uncertain about what's happening in the market, and therefore that drives the need for more transparency. So in the sense that, you know, we would like to see better definitions of what can happen in a dart pool, so they're very clear to us and they're very clear to our clients. We would like to see it mandated that clients know where their order has been executed, know where it's been routed. That's all positive change, because what that will do is it will make the buy side much more comfortable with the current market structure. What we're concerned about is that level of transparency can get distilled back down to a lack of choice for the buy side in terms of venues, whereby it's seen that the less choice there is, the easier it is to give transparency. Now, we don't force clients to trade on any specific venue. We talk to the clients about the venues that we can go to, and it's their choice. So clearly there is a demand to trade in these venues. And anything that would actually try and promote transparency and reduce choice, we think would probably be bad for the market, and certainly is not what our clients are asking for. However, if we don't start giving a certain level of transparency and comfort, we will end up with limited choice and perhaps back to a scenario where everything trades on a single lit exchange, which, as you say, is not good from a cost point of view of implementing your trades.
It's interesting because I know that a lot of people are also talking about the opposite being true, that with fragmentation, particularly with MiFID II coming in, that actually might create perhaps too much choice as well, that there are going to be far too many venues and it might dilute the opportunities as a result.
Yes, I think that is a danger with MiFID II. I think there's some aspects of MiFID II that are going to mitigate that as well. I think the subject of a consolidated tape has probably been done to death, so I won't go into too much detail. But clearly what clients, it's very much supported by clients, it's been supported by the sell side as well, is that what was missing from MiFID I was a consolidated tape, a very clear and transparent and economical view of what's happening in the market, so you know if you traded at the right price. I think if that gets implemented, then people become more comfortable with fragmentation because it gives that level of transparency and comfort that people need to deal in a fragmented market. There is, however, a risk, as you say, about a kind of super fragmentation resulting from MiFID II. There's an aim which is to be able to correctly identify and categorize all the different types of crossing networks that could exist in the market. One of the results of that is that the current structure, the BCN, broker crossing network structure, that's used by a number of houses, including ourselves, to provide crossing opportunities for clients, will have to be split into multiple different pools depending on what they're crossing with, whether it's client to client, client to prop, client to principal. In order to carry on doing all the activities we're doing today, we may reach a point where actually we have to run 3 pools rather than 1. Now, that does give the client the ability to understand exactly what is in that pool, but at the same time, it fragments the market further and probably reduces transparency. So there's a balance here we're trying to strike between choice, transparency and trying to avoid a scenario where things fragment beyond control, and really that's not in anybody's interest.
Now, I know you said it's been done to death, but if I can ask just one quick question on that world of the consolidated tape. One of the things that's been argued when the first proposal, the first draft came out with MiFID II, is that actually there's been a bit of a backpedal on the world of a consolidated tape, where originally we were talking about a single mandated tape for Europe, end of, and now it looks like they're looking at a privatised version where multiple people can offer different types of theoretically consolidated tapes. Is that actually, does that not defeat the object by going private?
I think the role of regulation in this aspect is actually to mandate the correct tags to be applied to trades. So each activity is understood across the market with a single definition, and everybody complies with that definition. How you then deliver that data to clients is a question of whether you take the US model, which is a utility model, and that's presented to the market and it's run, you know, almost on behalf of the market as a utility, or whether you decide that a private and competitive solution is better, and that way you can encourage innovation and best in class effectively. I think my personal view is that we would like to see some competition in that area rather than a utility, because we think that, you know, we work in a competitive market, we work in a market that has quite a lot of innovation on the technology side, and we'd like to see that continue for the consolidated tape. And that should also help compete down pricing as well, so this is accessible to people. However, we wouldn't want to see that at the risk of, as you say, a scenario where you have multiple solutions with multiple different interpretations of what consolidated tape means. So we're very supportive of the FMA solution that was proposed by a number of buy-sides last year, that kind of presented an idea where the actual utility could be put up to tender to private firms who could then compete for that, and in reward for competing for it, they get to keep the contract for a certain number of years. One of our biggest concerns around MiFID II was actually the size of the regulation is such that there's a lot of details still to be thrashed out, and this is going to move quite slowly. And what we didn't want to see was the consolidated tape being slowed down by that legislative process. The recent amendments that we saw put out to MiFID II encourage the creation of consolidated tape in advance of MiFID II being put in place, and I think that would be something that the whole market wants to see.
So overall, and it might be a little too early to tell, and feel free to say so, but because obviously we're still at that just post-draft stage. But do you think that MiFID II is overall going to be positive, or do you think that as it currently stands, it might end up actually negatively affecting markets, at least in the short term?
Yeah, I think we've definitely seen that you know, everything we predict about legislation is either right or wrong, but there's always something you didn't think of that has both positive and negative effects. As I say, we're very positive on the consolidated tape proposals. We're very positive around the fact initially that dark pools were going to be properly categorised, that we had a new OTF category whereby there's been a little bit of a grey area operating around a proper definition of a systematic internaliser. Up until relatively recently, when BCN was proposed, there was no real category if you didn't want to be a systematic internaliser or an MTF. So we were quite pleased to see that, you know, a lot of this activity that maybe is happening in venues which don't have a proper categorisation was going to be addressed by the OTF. So from that point of view, we were quite positive it was moving in the right direction. I think the recent amendments whereby they're saying equities can't take OTF category, and you're now left with a choice between becoming an MTF, whereby you have no discretion about who is in the pool, how the matching works, which is contrary to what clients are asking us to do. Or you have to become a systematic internaliser, and the obligations around making markets with competitive quotes on instruments you're crossing kind of obliges a firm like ourselves, which doesn't have a desire to be a market maker, to launch an additional business just to answer the needs of our clients. So we think that debate probably still has further to go, and we think it would be a shame if it does reduce the choice in the interest of transparency in this case.
Now, we are almost out of time, so if I can just ask you one very small final question. You are going to be also, as well as TradeTech Europe, you're going to be at our offshoot event, TradeTech DACH, over in Germany. What is it about that region and those markets that's so significantly different and that you feel needs a different approach, and perhaps how so?
I think that obviously the TradeTech London event is a great event. It's very pan-European. We see clients from all over Europe coming and all over the world, in fact, who are interested in developments in European markets. What interests us about being a participant in some of the regional events is we get to meet a client base that is in some cases more domestically focused than some of the German clients we see come to London, but also some specific issues around their market which they would like to see addressed. We do find that end investors, for example, have a different appetite for accessing dark pools depending on the region that they come from and depending on the legislation and the kind of drive of legislation from the local regulator. So we like to get involved in those markets individually, understand those specific needs rather than trying to come in with a pan-European solution and be able to respond to that.
Well, thank you very much for taking the time out to speak with us. It's been genuinely fascinating. I'm very much looking forward to seeing more from you in the panel debate over at TradeTech Europe in the next couple of weeks. If people do want to find out more about, Quantitative Electronic Services at Societe Generale, where can they go?
Well, firstly, at TradeTech, we will have a stand at TradeTech right at the front, and so we'll be very visible and very much looking forward to meeting everybody. And also, please contact us direct, and we would love to talk to people.
Fantastic, and if you want to find out more about the event, including how to actually come along, you can visit tradetecheurope.com. And if you'd like more information about TradeTech in the DACH region, that would be TradeTech DACH, DACH.com.